Today, we're going to talk about what happens to your mortgage if the dollar suddenly collapses. I always think about it as like, is it good for a homeowner if the dollar collapses? Like, what does it mean for real estate when the dollar collapses? Okay, what does the dollar collapse actually mean? It means when your buying power goes down. Traditionally, it's like when they say the government is printing money, and that's essentially what happens. But today, they just push a button and add dollars into our system. So if they say we're going to provide a stimulus of $50 billion or something like that, theoretically, that's going to infuse money into the system and make your buying power less. There's a lot of examples of this. I mean, worldwide, like the Weimar Republic before World War One or after World War One. That's kind of what brought the whole Germany and Hitler thing into existence, is that they were printing so much money. I mean, like it was like a loaf of bread was going up by the minute. It was kind of crazy. Zimbabwe had something similar. Argentina did, I believe, in the late 60s, early 70s. And the States, we had a few. I got some notes here just to make sure I'm on point. The Great Inflation, that's the 70s and the 80s. And a lot of people think what caused that was Nixon taking us totally off the gold standard in 71. You obviously had OPEC come into existence and forced up gas prices, which changed everything as far as how we drive, and that's where the 55-mile-an-hour speed limit came in. I mean, lots of interesting historical things, not related necessarily to real estate, but kind of interesting. So yeah, they called it the Nixon shock, and if you went and looked at a graph, 1971, and then just kind of looked at inflation or costs, like it's very this way, very, very up and to the right after 1971. And ultimately, it just means that your dollar purchases less over time. 1913 was another big one where the Federal Reserve came into being. And prior to that, there was no Federal Reserve, no federal income tax. So, that's really where you started to see the dollar move away from actual real money, gold or what have you. You had the Great Depression currency shift, and that's where I believe the FDR government was confiscating gold. And in an attempt to take us off the gold standard, and gold doubled in price in that time. Anytime you reduce, you're going to increase the value. So a little bit of post-COVID as well. We saw some inflation peak in 2022, and in the Arizona market, we saw about a 30% increase in home values in 21. So if your house was worth $300,000 in 2020, it was worth $400,000 in 21. And those prices, they settled a little bit in 22, but we're still on the upper end, I think, of our home value spectrum. Like, we're not a cheap place to live anymore. Pre-2020, this was the place to come get way more house than you could get in Chicago or California or what have you. So what happens to real estate? Your dollar starts to become worth less, meaning that you're buying your dollars just don't buy as much. Land obviously can't be printed, so if you own a hard asset like real estate, that's in your favor. And housing demand is always going to be consistent because we all need a place to live. Real estate often rises with inflation. A $400,000 house may turn into $800,000, and if you're owning that $400,000 house and making that $400,000 payment, well, now it looks like you've kind of won the lottery, or you're in a very advantageous position because everyone else is buying your same house at $600,000, $700,000, $800,000. And that's kind of happening right now. Folks that bought in 21, 22, 20, they're sitting on a 3% payment. Paying $2,000 a month for a $500,000 house, that they purchased for $350 maybe. So selling that house to go buy the $500,000 house at a 5, 6, 7% interest rate, that's not exciting. So that's part of the reason that I think inventory in Arizona has, like, if we got over 5 or 6,000 homes on the market per month, that was like great. So we had a major inventory shortage. Now we kind of have a bit of a glut of inventory, and a lot of that's because people are sitting on low interest rates and prices are up. So affordability is really an issue. Again, if you have a fixed rate mortgage, your payment stays the same and your home values just keep going up. So that's really where the rubber meets the road with inflation and real estate. Is if you're already in, you're at a benefit. If you haven't got in yet, you probably should. I have clients and potential clients that have kind of been on the fence for a year, 2, 3. Some of them started in 2020 and still haven't pulled the trigger. You can't wait out the market. What the market's going to do. And what you want to try to do is get the best price. You can always change your rate. You can't change the price of your home. When inflation happens, at some point, income and wages do catch up. It's generally a lagging indicator, maybe 18 months. So once you start to see like milk or gas or some of our consumables increase, then eventually you're going to see the income come from behind it. Rarely does it catch up to the cost of the new. If you're owning a house, now you're feeling like you're getting a deal on your 3%, $2,000 a month mortgage, where renters, they keep seeing the price go up because landlords are going to adjust for inflation. And what they should do and sometimes does, is it kind of pushes people into buying. Right now in the Arizona market, it's kind of tough because you can get a house for a decent area, less than $2,500 a month. I mean, you're not buying that house for $2,500 a month. So that's the tricky part, is in the short term window, that rental is going to seem like a better deal. Take a 3 to 5 year look, now you're $2,500 a month. Over 3 to 5 years, it's turned into 28 or 3,000, where you could have purchased that home for maybe 3,000 a month and benefited from buying isn't always better than renting long term. I think it is. There's an argument for the getting as cheap a rent as you can and maybe investing it in some other hard asset. That's fair, but most people won't do that. So you got to live somewhere. If you can own it, often makes sense. Arizona over the last few years has kind of been unique. We've got major migration to Phoenix, Mesa, Scottsdale, Buckeye. You're starting to see even Southeast Valley, Maricopa, and Santan Valley start to come alive. People are straying a little further than they would have maybe 5 years ago to find those better deals, and they're willing to make the drive. We all are going to make concessions on something, and if that's where you live and you can save 50,000 or 100,000 on a house by traveling 30-40 minutes away, maybe that's worth the trip. People are coming here because traditionally we have lower house prices and incomes are pretty good. Now you're starting to see major businesses come here, and so I think we're becoming kind of a big city. We're a big city and we don't know it, but it's coming. I think the Phoenix metro is really going to start feeling that as we move forward the next few years. New construction is still a thing. Inflation affects new construction in hard costs: wood, transportation, labor, if you will. So as inflation happens, new construction, it may stifle it. It may, if builders don't think they can build a house that they can sell for what they built it for, then they're not going to build as fast. In Arizona, most of our building is happening on the outskirts of town because most of the infill and land inside major cities has been utilized. They call it infill. Sometimes you'll see a new build of 20 houses or 10 houses pop up, but for the most part, that's happening on the outskirts. And we're seeing a lot of apartment buildings, master plan apartment communities, Mark Taylor, stuff like that. And those are great, but they don't really help the purchase market. And potentially they drive up the average rental cost in the city just because these are brand new, and there's the pool and all the amenities, and they're beautiful, but yeah, from a purchase perspective, it doesn't do a lot in the event that inflation does really bounce or explode. You might see mortgage rates jump. I think we're on the backside of that, and I think we're going to see mortgage rates come down hopefully when this Federal Reserve change happens in May 2026. We'll see, but sometimes change is good, and hopefully it is in the Federal Reserve, because they don't directly drive the mortgage market, but I think that the new person's going to want to make some changes and maybe make a little bit of a splash. So we might see some cuts in mortgage rates, or the government might start buying mortgage-backed securities, and when that happens, we're going to see a little bit of a dip in rates. So continuing down the line here, what should smart homeowners do? Lock it in. You always want to lock in your fixed rate, because that rate's going to let you know what your house payment is going to be for 30 years going forward, or until you decide to change it. If rates come down, you can always change it. It's nice to own hard assets, things that aren't going to be negatively affected when inflation comes. Real estate, land, rental properties. Generally, you want to avoid adjustable rate loans, because if the market does shift, especially in an inflationary pattern, that's going to portend poorly for you, because that rate's probably going to go up. So if you have a HELOC, or you're on a adjustable rate mortgage, or you're at prime plus, whatever prime is, whatever that prime rate is, whether it's based on the LIBOR or some other factor, that if that goes up, then your payment's going to go up. So those are things to think about. If you're using money in a short-term way, then maybe that's a good idea. But if you're planning on keeping that home equity line of credit open and have money on it for 5, 10, 15 years, you're going to probably want to try to roll that into something into a fixed rate. If you are a landlord, you're going to have the opportunity to raise rents when inflation happens, and that's just part of the game, unfortunately, for the renters. But if you're on the other side and you're the homeowner or the landlord, then I think you're in good shape. One of the biggest myths when it comes to inflation is the dollar collapse doesn't mean, it's not a downside for housing. People always think that one begets the other, but that's not the case. So in most cases, real estate's going to become more valuable relative to currency, again, because it's a hard asset. This is something you can always have, and you could sell it. It's kind of like gold. This isn't a gold conversation, but it does apply to gold, because gold is something hard that you can always sell in times of need. And when a fiat currency or something that isn't real starts to affect us negatively, you start to see more people move to gold. So I hope this kind of makes sense. Like I said, at the end of the day, if your dollar is buying less, hard assets are where you want to be, and real estate is that. So That's what happens that's what happens to real estate when inflation comes calling, and it tends to come calling every 8 or 10 years. So bottom line, do what you can to put yourself in a better position. If you have questions about home buying, I'm happy to help. I'm on the mortgage side, and we do all the money stuff, but there's a lot of strategy that comes with that, and always here to answer your questions. Hope this makes sense. Hope you have a good day.